Okay, hi everybody. Thank you so much for joining. We're going to get started here. There's still going to be some folks coming in, so we'll get started, and we'll hope for everybody to join as we get going. But lots of folks here already. Really good attendance today. Really excited about the session. So there's obviously strong interest for this conversation, which we're really happy about. Just a quick note off the top, we're going to be recording this webinar so we can share it with folks later, and we'll also have the slides available we can make available for folks if they want to follow up later. Yeah, and I'll start by introducing myself. My name's Adam Scott. I'm the director of SHIFT. I'm a climate expert who's been working on issues around climate for more than 15 years for a number of different research and advocacy organizations. Working to resolve the climate crisis at the provincial, federal, international levels. I have a really deep expertise in climate policy and energy. And yeah, really excited to be working at SHIFT. I've been working on this project for about a year, and it's really picking up momentum quickly. So my colleague Patrick is also here.
Yeah, hi everyone. Thanks for coming to the workshop today. My name is Patrick DeRoshi. I'm SHIFT's Pension Engagement Manager. I've been working on climate and energy policy issues for about 6 years now for various energy research and advocacy organizations. Again, like Adam, deep knowledge and experience in federal and provincial climate and energy policy, carbon pricing design and climate action programs, energy project review processes, and a lot of knowledge about oil and gas infrastructure and markets and transportation as well. And I've been with SHIFT for about 7 months now, so also fairly new to this, but bringing deep climate and energy experience to this organization.
Yeah, that's great. So just another quick note, we're not providing direct financial advice. Just a disclaimer there. We're a lot of financial expertise, but we're not giving you direct financial advice. Yeah, I wanted to start by thanking everybody for coming out today. I know teachers are facing a lot of challenges and the moment, managing life in lockdown and the requirements of teaching remotely and all of those various stressors. And it's a really big deal for you to take an hour out of your day, especially a beautiful day like this one. And that means a lot. And I really appreciate you doing that. We've got really, really strong interest. We had over 100 RSVPs for this session, which is the max. So a lot of teacher interest out there, and really glad you made it. We're also going to hear from 2 Ontario teachers today. We'll introduce them a little bit later, and they're going to speak to their experience working on this issue, and they have been working on this longer than we have at SHIFT. So that'll be really interesting. And I'll tell you a little bit about SHIFT, our organization. So SHIFT is a small nonprofit project. We're funded by private charitable foundations. And we have 2 primary goals. The first is to protect the retirement savings of Canadians from the risks of this climate crisis. And the second is to use the power of those retirement savings to help actually stop the climate crisis itself from getting worse. So we're just a small 2-person team, and we're focused on providing education, strategy, and tools to Canadians to engage their pensions. And while we do talk to the pensions directly ourselves, it's not as if pension funds are greatly motivated by a small nonprofit directly. What really, the power lies with you, the beneficiaries, the actual members of these pension plans. These pension funds work directly for you, and they've been hired to manage your hard-earned retirement wealth. So they have a legal responsibility to you, and you're in charge. So it's really important to remember that ultimately the change will come from those who are members of a pension plan speaking up. And it's important to understand a little bit about why we're so focused on pensions. Pensions are the hard-earned wages of Canadians, and it's really important to protect them. And there are many risks to those to pensions from climate change. But it's also important to remember that these savings pools are among the largest pools of capital on the planet. So the top 10 pensions, the biggest public pensions in Canada, have over $1.5 trillion in assets under management. Total in Canada, all pensions combined are larger than Canada's GDP. So you can see the scale of that amount of investment, and decisions are being made every day about where those investment flows go to. And that's critical in a conversation about how we're going to address the climate crisis. So pensions are incredibly important. Here's a quick rundown of what we're going to talk through today in our workshop. Quick introduction, which we've just done. We're going to do a very brief glance at climate science. I know that's a review for many folks, but it's important that we just put the appropriate context in place. We're going to spend some time talking about the financial risks of climate change, as well as the opportunities that come from the transition. We're going to talk about the Ontario Teachers Pension Plan itself and how it, sort of some high-level review of it, and hear from some Ontario teachers who've been working to engage the plan already in their different communities. We're going to talk about the Teachers Pension Plan current approach to managing climate risk, their investments in fossil fuels, and we're going to talk about the overall and long-term likely financial performance of fossil fuels. And finally, we'll wrap up the session by talking about how teachers themselves can effectively engage the Ontario Teachers Pension Plan. And we've launched a new tool today that is live and has its own website, which we'll show you and we can look at. And then we'll have lots of time for questions and hopefully some discussion. So yeah, that's the outline. Let's get right into it because we don't have a ton of time. Just to quickly note that if you have any questions, we're going to try to leave some time at the end for Q&A. There's a chat box that you can get into from Zoom, and if you put your question there, we'll read the questions from there, which should make things a little bit easier. So first, a really quick review of the situation we find ourselves in with the climate crisis. Concentration of CO2 in the Earth's atmosphere has increased by more than 60% in an incredibly short period of time, primarily due to the combustion of fossil fuels, but also due to some land use change. This is a graph that shows measured CO2 concentrations in the atmosphere, which continue to go up dramatically every year. This is what's driving that increase in CO2 emissions. You can see this is the burning of coal, gas, and oil of fossil fuels. And this was previously trapped carbon that was in the ground, safely in the ground, and has now been dumped into the atmosphere and is now part of our circulating global climate carbon cycle. So this has upset the balance of our climate and destabilized it. And this is what that looks like. This graph shows the temperature data over that same period, and you can see very clearly the impact of human-caused warming. And there's a very clear consensus in the scientific community on the causes, on the effects, and on the solutions. And there really, frankly, has been now for 20 plus years. So, you know, we don't have any excuses for inaction at this point. So let's talk about how that sort of plays out in the real world. And there are countless very significant impacts of a warming world on our climatic systems. And these disruptions lead to an increased likelihood of severity of wildfires, floods, heat waves, droughts, sea level rise, and extreme weather, which damage the systems and infrastructure that underpin our ecosystems and our economy. And some really concrete examples that sort of give you a bit more of an economic viewpoint on this. The top left slide there of the slide there, you'll see that's Houston during Hurricane Harvey a few years ago. Unprecedented flooding from a hurricane caused very substantial economic and loss of property and infrastructure and life. On the top right there, that's a photo from Cape Town, the first major global city to almost completely run out of water. I was there during the drought, and it had a huge impact on the city and its ability to function, on agriculture, on tourism, and they narrowly avoided running completely out of water, but that's expected to happen in a number of major cities around the world as climate change accelerates. The bottom left there, you'll see that's the Columbia Glacier on the Alberta-BC border. The headwaters of the Saskatchewan River Basin, which supplies water to the driest parts of the Canadian prairies, and it's rapidly melting, and we're looking at in future water levels dropping potentially as the glacier melts, and so we could see long-term very substantial impacts to agriculture in the central part of Canada. On the bottom right there, you're looking at the Fort McMurray wildfires, the Beast, which caused massive industrial disruption and burned down 10% of the city, and that's just one example of many, many catastrophic wildfires we're seeing circulating the globe and getting worse every year. It's having major impacts. And of course, within Canada, we're seeing the strong signal of this already impacting our economy. This graph just shows insured losses, but you can imagine the real impacts of this are much higher than this. And this is from the Insurance Bureau of Canada, and you can see just the increase of these types of events. And of course, this graph doesn't even include massive wildfires and floods we've had more recently. The Ottawa River, St. Lawrence River flooding we had 2 years ago is one example, in wildfires in BC. So obviously all of that is incredibly scary stuff. And I know many of you are here because you know all of that. And you're concerned and you're looking for ways to have an impact. And this graph, for me, really helps explain the way out. There is a way out of the climate crisis. There's a way to stabilize warming. And we really have no choice but to cut off the root source of the problem, which is fossil fuel combustion, but also land use change, deforestation, and some industrial emissions. But overwhelmingly, fossil fuel combustion is the biggest piece. And that means transitioning our energy systems, plural. And that has to happen incredibly quickly. So this graph shows the trajectory needed to keep warming below a 1.5 degree threshold, which is enshrined in the Paris Agreement. And the longer we wait, the harder that gets. So there's two things I really want you to take from this graph. And the first is that we're not aiming to merely just reduce emissions. Reduction of emissions on its own is not a useful frame. What we're looking for is actually a path to reducing emissions to zero by approximately mid-century. That's what's required to stabilize warming at I won't say safe, but at a threshold which avoids the worst impacts. And the second thing I want you to take away is there's a real cost to inaction and delay. The black line you're seeing there on the left are actual real world emissions on an annual basis. And you can see the trajectories. If we had started down the path of reducing emissions in 2000, when we had ample evidence to do so, there would have been a smooth and simple not smooth, but a smooth and gentle transition, which would have allowed us to go quite a long time. And every year we've delayed, it gets harder and the curve gets steeper. And we're right at the top of the graph there. You can see how challenging this already is. So we can't start slowly and move down. We really have to actually dramatically start moving on transitioning the energy sector. And so when we're thinking about pension investments, I want you to keep that in mind. Where capital gets invested in the future has to align and push this curve down. So we want to learn a little bit more about who's on the webinar and sorts of levels of experience and knowledge and questions that are coming up. So we've come up with a quick survey. So we're going to post a survey question or two here and there throughout the webinar. So we're really curious to know if you're really familiar with the science of climate change, or if you'd like more information on this. Certainly we can provide more opportunities to learn more about that piece of things. So please fill it out. And I'm going to move on and keep talking quickly here. I hope I'm speaking at a pace that works for everybody. And I want to talk about specifically the financial risks for pension funds that climate change creates. And these are risks that impact anybody who's got investments out there in the real economy. So I'm going to go through these very quickly. But it's really important here to note that climate change is clearly a moral issue. But from the perspective of protecting your pension and from your pension managers, it's also a financial issue. And the pension fund, the Ontario Teachers Pension Plan, has a clear fiduciary duty to be investing in the best long-term interest of its beneficiaries, all of you. And that means investing in the best interest of a new teacher who's in their 20s, who have 30 years before they're going to retire. They have to be able to grow the pension and have the savings actually be there when that person retires at the end of their career. And so that's a very long-term perspective. So we're going to talk through the 4 rough buckets of climate risk. And in each category, you'll see how these impact different types of investment. So the first and most obvious is the physical risk from climate change. So increased fires, floods, heat waves, droughts, sea level rise, extreme weather, damaging infrastructure and systems, And you can imagine, in particular, large pension plans like teachers owns a lot of commercial real estate, utilities, and infrastructure. And those are directly at risk from climate disruption. That's all fairly self-evident, as is this area of transition risk. So, we've seen rapid disruptions and transitions in different industries over the years, and I want you to sort of put your mind to thinking about some of those. On the slide here, we've got, Blockbuster Video is a good example of what was a profitable business in the 2000s that had value, that promptly went bankrupt and evaporated when Netflix came along with online streaming. We're giving the example there of a very long time ago, the transition from horse and buggy to cars took, in North America, less than 15 years, from nobody having a car to everybody having a car and everybody getting rid of their horses as their primary mode of transportation. And the example there as well of film to digital cameras being disrupted by smartphones. Those are rapid technological disruptions. And climate change is accelerating a number of major technological disruptions, particularly in the energy space, and in a number of other places as well. But it's really important to understand that fossil fuel companies in particular are vulnerable to a number of very strong transition risks. They're valued, the companies themselves are valued based on their reserves that they can extract in future. And with climate change, their ability to extract that carbon just won't be there. And here's some more quick examples of what that disruption's already looking like. This transition is well underway. As we've produced more solar panels, the cost has dropped. So solar panels are now incredibly cheap. They are no longer an expensive technology. In fact, they're the cheapest form of new electricity generation, second only to wind power. So wind power is actually even cheaper than solar at the moment, but they've now crossed that threshold where they're cheaper than fossil fuels and are rapidly disrupting the utility sector. Similarly, battery technology has gone through a similar drop in cost, and we're already approaching parity where batteries used in vehicles will be cheap enough that electric vehicles will soon be cheaper than internal combustion engines sometime within the next 5 years, it's estimated. But they also have huge implications for electricity storage on the grid, and they can disrupt natural gas electricity generation. And you can see that the transition risk is already starting to bite into the bottom line of fossil fuel companies. And there are a number of different ways in which fossil fuel companies are facing major economic challenges at the moment. But you can see that very weak returns over the last 10 years, and we'll talk about this a little bit more in future here. Yeah, and you can see this graph on the left here. If you can see it, it's a little bit small, but it shows the performance over the last 10 years of different sectors relative to a benchmark. So you can see the renewable energy sector is far outperforming fossil fuel related and exposed industries. And of course, this graph was taken before the COVID-19 crisis, which has really accelerated what's happening. And I will just note quickly that the pandemic crisis right now is a very much, it's having a very significant impact on demand for fossil fuels. That the depth and speed of it is incredibly rapid, but it's very similar to what you would expect over the long term in terms of risk from action on climate change, which would be a much slower but very systemic change over where we will see a destruction of demand for fossil fuels. And renewable energy is the one sector right now during the pandemic that's actually come out positively, which is quite something, or one of a small number of sectors. Right, moving on. Other types of risk. So this is policy regulatory risk. I won't need to talk too much about it, but only to say that risk due to laws, policies, regulations to cut carbon pollution will have a significant impact on a number of industries. And we're already seeing those coming into play in Canada and around the world. Carbon pricing, electric vehicle policies, banning internal combustion engines, retrofitting buildings, cutting industrial emissions, etc. And to say that our current policies and regulations are quite weak relative to what is required to address the climate crisis. So we need to expect greater stringency over time, and to plan for it. And you can expect, this will have a huge impact on the risk faced by different sectors of the economy. And legal and reputational risk. So we're seeing a very similar dynamic to what we saw with tobacco companies in the 1990s with fossil fuel companies. Fossil fuel companies, just like tobacco, knew that their products caused harm, and were involved. There's strong evidence they were involved in actively covering that up and obscuring the challenge. So we know fossil fuel companies were lying about and funding climate denial. And there are a number of legal challenges currently ramping up, damaging both their financial and reputational status. So that's something to watch out for. I think this is an area that's just getting started, but moving quickly. And finally, I want to just pause on this slide. This is something that is not well understood or talked about, but really critical to understand in the context of long-term pension investment. So if you really want to protect your pension over a long time, this is what's most important. The largest risk to your retirement comes from climate change itself. So even the most sophisticated investors, and Ontario Teachers' Pension Plan is one of the most sophisticated investors out there, are unlikely to be able to protect your pension from runaway climate change. If we don't address the crisis accelerates and gets worse, and it starts to cause cascading impacts which disrupt the systems that underlie our economy. So we're facing, if we don't deal with climate change, we're going to see growing headwinds to all areas of GDP growth, which will make it impossible for any type of investor to make reliable returns. And so this is, the collapse of our food systems, water shortages, mass migration, geopolitical destabilization, those sorts of things we don't like to think about when it comes to climate change, will make it very difficult to make money investing in anything. And that's why it's critical, and we believe the fiduciary responsibility of pension plans is linked to being part of the solution to the crisis. We actually have to address the climate crisis if we want to protect pensions. And finally, really important to, I think we'll just say it's unless major policy and financial changes are made from what we're doing today, we can expect some of that portfolio risk to actually occur. We're already starting to see headwinds to GDP today that are measurable. So finally, I wanted to just to talk about how there's actually a huge opportunity as well. It's not all doom and gloom. If investors want to grow investments over the next coming decades, the best opportunities to do so actually come on the flip side of that technological disruption I talked about. So there's lots of investment opportunity and lots of places to grow, and they're all in solutions to the climate crisis, or many of them are in solutions to the climate crisis. So we're talking about trillions of dollars of investment opportunity in renewable energy, in infrastructure, in electric vehicles, and a number of different technological areas, but that's also retrofitting buildings, public transit, lots of ways to invest in the solutions to the climate crisis that are profitable and likely to grow. And here's a really sort of helpful example of that. This graph shows groupings of European utilities. So the five cleanest and the 5 dirtiest over the last 5 years, roughly. And you'll see that the green line, the cleanest, who have been investing heavily in renewable energy and moving away from things like coal and gas, have been outperforming quite substantially and are far more profitable now compared with the utilities that have not made those investments. And so already this is a very smart financial decision to be moving into the solution side. Okay, we blasted through that quite quickly. So this is a quick overview. I want to talk very briefly about the Canadian pension model, which is just to say, these are the 10 largest pension funds in Canada. The Ontario Teachers' Pension Plan is the 3rd largest. But the model is important to understand a little bit as well. Traditionally, pensions were passively invested. And if it's particularly a public plan, they were, as many of you will probably know, they were invested sort of passively and sort of through various government agencies. And the model changed within the last 20 years, where most of the large pension pots were actually handed over to professional financial experts who are essentially private and independent, and they were asked to manage the plan. So the Ontario Teachers Pension Plan is an example of, it's the prime example of the Canadian model for pension investment, which means having very high performance, very sophisticated investors actively managing the plan. And that gives them great latitude to do all sorts of things that are above and beyond sort of passive management. So you should expect good returns from them. And it's important to note that the Ontario Teachers Pension Plan is, by all measures, a very well-run pension plan. It has done very well in terms of returns, and it's very well respected internationally. And this underlines why it's also important that the Ontario Teachers Pension Plan doubles down and does more on climate change, because it's significantly globally influential in the financial world. And it'll have that knock-on effect. Great, let's see. Okay, well, let's pause here for another question. We really genuinely want to know, have you ever engaged with your pension plan to talk about your pension? Doesn't necessarily need to be climate related, but have you had the experience of asking a question or engaging your pension plan? Is that something we're trying to find different ways of doing, and we're interested in how that goes. And I'll pass it over to Patrick here, who's going to introduce some.
Thanks, Adam. I'm also going to share the results of the first poll. So it shows that we have a pretty smart group here. It's not surprising since it's a group of teachers, but most of you consider yourself to have average or knowledge of climate science and the impacts of climate change. And we even have an expert in the crowd. So I'll let you guys answer the second survey question, and we're going to shift gears for a second here. And I'm going to introduce actually a couple of teachers that have been working on this issue for a while now. And that's Kim Fry here in Toronto, as well as Terry Burgess up in Marathon, Ontario. And I'm going to switch over to them so we can hear from them about why they've been involved in this issue for so long as an Ontario teacher.
Thanks so much, Patrick and Adam. So yes, my name is Kim Fry, and I teach in downtown Toronto, and I have been working on the climate connection to our pension plan for as long as I have been a teacher. I'm probably influenced by my first career. Teaching is my second career, and I was a campaigner with Greenpeace before becoming a teacher. So it was very much on my radar that the Ontario Teachers Pension Plan was one of the largest and most influential in the world, and was heavily invested in the oil and gas industry. So I think my very first year I went to the OTPP annual meeting, and connected with Toronto 350, who are doing work on our pension plan, and really kind of dove in a little bit more, and have been most years active at our annual meeting, asking questions and asking for divestment. And my activism on this has been both directly to the Ontario Teachers Pension Plan and going to our meetings, but also through my union, which is the Elementary Teachers Federation of Ontario. And we have had motions for many years at our annual meetings, finally passed in 2018, to ask the Ontario, the OTF Teachers Federation, to begin to look at a divestment plan for our pension. But the other affiliates haven't necessarily been on board for doing that. So I don't know how far that's been, although I will say that ETFO has divested its own investments from oil and gas, which is very small compared to the Ontario Teachers Pension Plan, but at least the beginning of a conversation is there, and there has been some steps. And I feel like as teachers, some might be motivated by the risky investment that the oil and gas sector is currently, and the I guess worthwhile investment of the renewable sector, and that is for sure an important consideration. We all work hard and deserve good pensions, and the reason that the OTPP has generally done well is because it tends to be fairly risk adverse. But for me, the main motivation is that I'm a teacher. My job is so focused on my students and preparing them to be active citizens in the world. And it just, I can't sit well with seeing so much of the money that we invest being invested in a sector that puts at jeopardy and at risk their futures as well as that of my own children. And I really want our profession to be on the forefront and leaders in trying to encourage responsible investment, an investment that indicates the kind of future that not only we want, but we absolutely need to go as a world and as a profession. So we teach about environmental citizenship and climate change, and I think we need to put our money where our mouth is. So I don't want to, there's much more I could say, but I'll just leave it there for now and let Terry speak as well. And if folks have questions later on, I'll be around. Thanks.
Okay, so my name is Terry Burgess, and I'm a grade 8 teacher on the North Shore of Lake Superior. And I'm happy to say that I live a fairly suburban lifestyle up here, and I have a lovely home and lovely vehicles, and I go on great vacations, and I certainly would love to see that continue into my retirement. But I am interested in having my pension plan divest from fossil fuels because just on a very high level, it just seems very obvious, both from what Adam has said and from we can see our use of all sorts of technology that we're using now during the pandemic, that there's lots of other ways for us to make a really great income in our pension plan. This is not fringe thinking. Mark Carney, who was the governor of the Bank of Canada, was very clear that investing in fossil fuels is a big risk and that climate change is a big risk to our economy. So it just makes sense that we would change directions. And I just think when I think about my colleagues, I know one lovely one for sure is on with the 50 or 60 so people who are on the phone with us right now. I think about how hard they work for our students and for our own children. And certainly we know that this is not in their interest for us to sort of make our money while risking their future. So another thing that I find interesting is that our pension plan just divested from tobacco. Adam was talking about the tobacco industry's history and how similar that is to the fossil fuel industry. And we actually just divested from tobacco in 2018. So when I think about all of the health lessons I've given my students to ask them not to vape and not to use tobacco, and the fact that I was actually making money all that time by being invested in tobacco, that just makes me feel like I can't rely on those pension fund managers to make decisions that I think would be consistent with what I want and what my colleagues would like. And just to echo a little bit about what Kim said, when I also think about what really good teaching looks like, I think about my students being able to make this kind of decision that we're faced with right now. And that is that I want them to make sure that they're informed about issues and that they have enough knowledge to make good decisions. I want them to be doing good critical thinking. And I also want them to be showing good moral leadership. And I feel like if we can't make this decision to stop making money while risking their future, then I'm afraid I would lose my moral authority when I'm teaching, whether that be environmental science, whether that be critical thinking, whether that be health, whatever it is that I'm teaching, that then I start to lose that moral authority. And it just doesn't feel worth it to me when I know that I can make money in other ways.
Thanks so much, Terry and Kim. Both Kim and Terry will be on for the rest of the workshop, and we're gonna try and get through the next part in 10 or 15 minutes and leave some time for good discussion Q&A at the end. So if you have any questions for them, they'll be around. But now I'm gonna move on with the workshop, and we're gonna talk about the teacher's pension plan itself and how it's approaching climate change and its investments in fossil fuels. So just some basic info about the pension plan. It's the third largest fund in Canada. As of the end of last year, it had over $207 billion in assets. It's probably gone down a little bit since the COVID crisis, but still a massive pool of capital. To put this in perspective, that's roughly the size of the GDP of 8 of Canada's provinces and territories, or the size of the national economy of a country like Greece or New Zealand. There's 329,000 active working and retired teachers paying into it. And this is not just some RSP that's sitting there collecting interest. It's a massive fund that owns large parts of the real physical economy. So we're talking about airports, toll highways, utility companies, water utilities, ports, infrastructure, entire blocks of downtown real estates, malls, healthcare providers, just a big owner of physical assets. And it has massive influence to shape the real economy. It's highly respected in the financial world. It's a big pool of capital. And it actually has the potential to shape the economy and accelerate the transition to a low carbon economy, which is why we're having this conversation now. Next slide, please, Adam. Last year, we put out a report that gave a rough ranking of some of the pension funds in Canada. We are looking at the top 10 public pension funds, of which Teachers Pension Plan is the third largest. And we can see here that they're actually doing a lot more than other public pension funds. This report is from 2019, so this might have changed a bit. But they are taking the financial risks of climate change a bit more seriously. They are putting in place internal mechanisms to deal with it. But we do want to see them do more. And in fact, even the leader, the Caisse de dépôt et placement de Québec in this chart, is not doing enough compared to his international peers. And we haven't seen clear stated goals on climate change and targets from the pension plan yet, from the teachers' pension plan. We want them to commit to a timeline for understanding the climate risk in their portfolio. We want to see a clear timelines for increasing investments in profitable climate solutions. Next slide, Adam, please.
Patrick, I just wanted to point out in the chat, people are not seeing your slides. I think maybe your
great.
not shared.
I'll reshare my screen. I apologize for that.
No worries.
Oh. Sorry about that, but I will move on. We're on slide 28, Adam, if that is helpful.
Yeah, I'm on the right slide. It's just it wasn't sharing my screen properly, so we're still good. My apologies.
So, I mean, credit where credit is due. Like I said, the Teachers Pension Plan is doing a lot more than other Canadian pension funds on this. They have taken significant steps to assess climate risk and has done more than others. So right now, integrating environmental, social, and governance factors into their investment decision-making process. They have an internal framework to better understand and manage climate risks. They explicitly recognize climate change as a risk and investments in climate solutions as an opportunity. They're working with internal advisors as well as investment advisors that specialize in climate change. They're using a number of tools such as scenario analysis and carbon footprinting to better understand the footprints of their portfolio and the risks of climate change to the portfolio. And we've actually seen their investments in fossil fuels decreasing over the last few years as we've seen the sector underperform in the economy. With that being said, it's not enough, and we're not seeing the targets, timelines, and metrics that we need to actually adequately address the crisis. Next slide, please, Adam. So for one thing, there's inadequate disclosure and transparency. I've spent a lot of my time in the last 6 months digging through every public reports or available information I can find on this, and I still don't know the amounts of your retirement savings that are invested in fossil fuel companies or exposed to other forms of climate risk. So we don't actually know how much and how exposed this fund is. And that's a problem because we think that as retirees and workers, you should know how your retirement savings are being invested. It's unclear how the pension plan's climate risk analysis is actually influencing its investment decisions. So yes, they're putting the right processes in place and using the right tools, but we actually don't know how it's influencing the decision to invest in a company or a stock or not. They often talk about how they engage the companies they own to improve environmental performance or say reduce methane emissions that contribute to climate change. But they have quite an inconsistent record on voting at these company meetings. And we also don't have any evidence that this engagement has actually improved those companies' performance or caused them to change their behavior or business model. And like I said before, there's no clear standard or metric for screening out companies who are bad actors in this space. And the tools they're using are quite opaque, and we don't know the methodology or results, or again, how they're actually influencing decisions made with those funds. Next slide, please, Adam. Again, credit where credit's due. They have made an effort at the pension plan to increase their investments in climate solutions. So they do explicitly acknowledge that clean technology and other low carbon sectors that reduce carbon are attractive investment opportunities. So we've seen them increase their investments in renewable energy, for example. At the end of 2017, they had about $1.6 billion invested in renewables. That's actually quite a small amount for a fund as large as the Teachers Pension Plan, but it is a good start. They co-own a company called Cubico Sustainable Investments, which has 87 renewable energy assets around the world and growing. They also partly own Blue Earth Renewables and STEM Energy Storage. And their real estate subsidiary, Cadillac Fairview, is a leader in green buildings in stuff like energy use and water efficiency, as well as waste diversion. And like I said, they do have their own internal analysis at the pension plan, which shows the poor performance of oil and gas exploration and production companies. Next slide, please, Adam. On the other hand, there is massive investments from the Teachers Pension Plan in fossil fuels. A 2017 analysis from Corporate Knights estimated that it was $25 billion. We do think it's decreased since then, but from what we can tell from publicly available information, we're still looking about at least $8 billion in fossil fuels. This includes at least $200 million in Aethon Energy, Chisholm Energy, Hawkwood Energy, and Scotia Gas Network, which is natural gas in Britain. They own HRG Royalty, which is a oil and gas holdings company based in Western Canada that has the rights to oil and gas wells and properties. Their proxy voting records show that they have investments in oil and gas companies like ExxonMobil, Chevron, Occidental, pipeline companies like Kinder Morgan, and oil sands companies like Teck, Suncor, Canadian Natural Resources, Imperial Oil, and Phillips. And then they're still in coal, Duke, Dominion, Southern Co, and it really boggles the mind that they're still invested in the coal industry, which is the most greenhouse gas intensive and the poorest performing of all the fossil fuels. And even right now, as we speak, reports from the financial news are showing that the Teachers Pension Plan is in negotiations with a consortium of large asset managers looking to buy a stake in the United Arab Emirates natural gas pipeline network. So despite the progress that they're doing on managing and analyzing climate risk, there's still some massive investments here in fossil fuels. Next slide, please, Adam. Like I said, they explicitly don't screen for investments in fossil fuels. They prefer to engage with these oil and gas companies instead of divesting from them. And we haven't seen any evidence that has caused these companies to align their business model with the climate safe world and the Paris agreements. And like Terry kind of mentioned in her part there, they have ethical screens in other areas. So they divested from South African companies in the 80s to help protest apartheid and promote democracy. They signed a tobacco-free finance pledge in 2018 to stop investing in tobacco companies. They don't invest in guns and arms manufacturers, and they don't invest in companies that produce cluster munitions, anti-personnel mines, and biological and chemical weapons. And we find this particularly interesting because they say they don't do this because of their commitment to international treaties and conventions ratified by Canada. And that's a good thing, but why does it not apply to the Paris agreements to limit global warming to 2 degrees or less by mid-century? So we really think we need to ask that question about fossil fuels and why they don't apply that same standard to a product that is clearly harming lives around the world. We're going to pause here for our third survey question. So you should receive a prompt in Zoom quickly, and I'm going to switch it back over to Adam to wrap things up before we get to some Q&A.
Great. Thanks, Patrick. Yeah, we're going to keep it moving quickly so we have some time for questions. So we'll just get through to the end here. Just wanted to note that, the context for the financial sector has really dramatically changed. On January 14th, Larry Fink, the CEO of BlackRock, which is the world's largest money manager and institutional investor, published this letter that basically laid out climate change as the top issue for their clients, and basically saying they're going to rejig their entire investment strategy around taking climate change seriously. And this has had a cascading impact throughout the entire global financial sector. Finally realizing that climate change is something they have to take seriously. It's not just an ethical investment issue. It's not just a they talk about an ESG issue. It's core and fundamental. And the types of moves we expect to see from financial institutions and institutional investors like teachers is is to make unprecedented moves. Climate change itself is an unprecedented crisis, and this is an existential risk for them. I don't need to go through all in a huge amount of detail. We'll try to be quick through this, but just to say that fossil fuel portfolios, so those who have explicitly made their portfolios fossil free in recent years, have consistently outperformed the market. And it's proven to be a very effective strategy, so very financially wise, lower risks and higher returns on average. And we can see there's, we've already seen over $14 trillion in investments around the world put into fossil fuel investments. Yeah, I don't need to read all of the various stats, but just to say that we've seen the University of California UC system just completed their divestment of their entire portfolio this week. The New York City public pension funds have also done so, and the New York State pension plan is also looking at doing it. And the Norwegian pension plan, which was actually built on oil investment, originally, they're now changing tax to move away from the screening some investments on fossil fuels, which include oil sands investments. And this graph really explains the situation over the last 10 years quite well, which is to show that this is a graph of the S&P 500. Each of the different lines is a different sector of the economy, and you can see that energy, fossil fuels, is the worst performing sector over the last 10 years, and the returns have been dismal. And this is reflected in the same way in the TSX. Energy companies have had very poor returns over the last decade. And there are a number of factors related to this, but it's important to think about the future. When you're making investment decisions today, climate change will measurably impact the returns of fossil fuels in the future, and it should. And so we don't expect this trend to get a lot better. We shouldn't expect this sector to be somehow breaking out and performing better. So let's move on to how Shift can help you to engage with your pension plan, to ask smart questions about this issue. And we've created toolkits for Ontario teachers. So we have all of the information and more of what we've talked about in this webinar we have in that toolkit. So you have all sorts of information, smart questions you can ask, all the background information we've gone through. We're continuing to deliver workshops like this, and we're doing it for a particular group. So if you have a group of teachers that you think would benefit from having a more in-depth discussion or learning more, we're happy to help. And we're launching our new online action tool specifically for Ontario teachers today. So if you go to shiftotpp.ca, and we can post the link and we'll send you information as a follow-up to this webinar today. But you'll see that there's a tool there which will allow you to write a letter directly to the key staff at the Ontario Teachers Pension Plan, and with your concerns and your questions. And we really encourage beneficiaries to ask smart questions and state their opinion, but also to ask questions, because the pension plan needs to follow up and respond to your questions. And we find that that respectful, constructive approach really works well. I think there are a lot of staff at the pension plan who really want to do a good job at this and are working hard, and hearing your questions is really important for them to understand where the concerns are. We can also schedule meetings with fund managers. We've had a number of beneficiaries in different public pension funds do that, and we help. So if you want to talk and have more specific or in-depth questions, we can help do that. We can help arrange those sorts of connections. I think maybe it was Kim that mentioned that she spoke at the AGM of the Teachers Pension Plan last year. This year it was online, so it was a bit of a tougher forum, but there will be more in the future and other public meetings that the fund holds. And so asking questions is a really good way to get a response and to engage. And we're involved in writing up high profile beneficiary letters from folks like the heads of the unions and and others that can be made public that are an open letter to the pension fund managers requesting them to take this issue seriously. And yeah, so we're looking for all those different ways in which engagement can happen. So I'm just losing my, on the back end here. There we go. Right, and we're gonna move on from there. So yeah, that's the end. Really strongly encourage you to start your engagement by trying out our new tool. And if you have any questions, you can reach us at Shift at info@shiftaction.ca anytime. We have a Facebook page, we have a Twitter page, we have a LinkedIn. Make connections with us. And we're really here to serve as a help to you. So if you want to get organized or reach out to more teachers or to organize something smaller, we're really interested in helping you do that. So we're friendly, approachable folks who can do that. So why don't we get into questions? Does that make sense, Patrick?
Yeah, just before that,
Yeah.
I'm going to quickly share the polling results. So that second question about teachers that have engaged with the pension plan, you can see that's the majority, over 60% have done so in the past. And hopefully that becomes more after today. And I'm going to switch over to the third question. And that was whether you agree with the statement that the pension plan should be investing my retirement savings in fossil fuels. And we see nearly 3/4 of teachers on this workshop agree that they should not be investing in fossil fuels, with a couple that are neutral and a couple that disagree. So we'll be sure to follow up with these results with folks who were on this workshop. And I think we can just jump into some Q&A and hopefully have a good discussion now. And just a note, we are aware that it's 4:53 and this goes till 5 o'clock, but Adam and I and Kim and Terry are available to stay on for another 15, 20 minutes after if folks want to have more of a discussion or have more questions.
I really want to thank everybody for coming out. And we hope to be in touch again soon. So Patrick, you're going to read some questions that came up in the chat. If you have questions, please post them in the chat.
Yeah, we have several, and I'll just start out by saying that yes, we are going to share this slide deck and workshop, the recording of it with folks by the end of the week. So we can give that to you. A few people have asked that. But I'll start with a question from Sandeep asking, what is the position of Shift on pipelines and other infrastructure such as shipping until sustainable alternatives are commercialized?
Yeah, well, I think having a really long-term view on that question is wise. So, right now there are a number of new infrastructure projects like fossil fuel pipelines being built or in the process of being applied for. And, those pieces of infrastructure tend to be built for a 50-year plus time horizon. Certainly the payback on projects like that is plus 20 years. And I've done a fair amount of work on the economics of projects like that. So what happens with projects like that is they tend to lock in increases in emissions. Canada's single largest, as an example within Canada, Canada's single largest source of emissions is actually production of fossil fuels, not consumption. So burning gas and diesel in our cars is actually secondary to producing fossil fuels here. And so for Canada to be able to reduce its emissions dramatically enough, we have to see fossil fuel production actually decline in coming years. So we have to be thinking about building new infrastructure that will support that long-term growth in production. There's a real question about whether or not those assets might get stranded. And I think we're not seeing the kind of caution around that from institutional investors that we would like to see. But we have seen a number of, on a global scale, of institutional investors start screening investments of that type from their portfolios. I hope that helped answer some of that question.
Yeah, and just a quick question of clarification next, Adam, from Maria Marr. And I think this might show up in one of our slides, but she's just curious if the Ontario ice storm in 2013 shows up in that data on catastrophic uninsured losses that we showed before. And I think it does.
Yeah.
Maybe you can just flip back there quickly to show that slide.
Yeah, if I could find the right slide for it. Yeah, it probably does. And there's, if it doesn't, I think what we were showing there was insured losses. So Yeah, I don't know if I can find, yeah, that's it there. Let's see, but yeah, there it is, Eastern ice storm. But again, this is this is insurable losses. So this is what insurance companies themselves had to pay out. But you can imagine what governments actually have to pay out on top of this. The costs are much more substantial. So there's usually, federal, provincial aid packages and billions of dollars in tax money flowing into infrastructure. And a lot of folks aren't covered by insurance as well. So there's that challenge. But what we're seeing is this trend. This is just a quick snapshot of what's going on in Canada, but we're seeing this. The insurance industry is well aware that they're facing massive and catastrophic losses, and so the insurance industry itself is worried about its own profitability, and the ability of getting certain types of insurance is also at risk. So we can have a whole conversation about how insurers are responding to some of these risks we're talking about. But what's important to note here is that the increase in these kinds of catastrophic losses is really ramping up now.
Yeah, Adam, Marie just clarified in the chat that she is referring to the 2013 Ontario ice storm showing up the data. So I'm not sure.
Oh,
if,
no, I'm not sure about that
in particular. But
yeah, sorry, I don't have that level of data here. But I imagine it would show up. But it's as with all climate-related sort of weather-related incidents, the signal of climate change is sort of in the background. It's the frequency and intensity of events like that are expected to increase and are seen in the signal. So it's very difficult to attribute any specific incident directly to climate change, but you would expect to see the frequency of those types of events and the intensity of them to increase. Okay. And that's what we're tracking.
KV has a question that we mentioned in our workshop promo material, that the Ontario Teachers Pension Plan has $8 to $25 billion in fossil fuel investments. Where do you find these figures? KV, we can spend a bunch of time trying to answer that right now, but as a follow-up to this, we're going to send our toolkit around that kind of gets into those numbers, so that we'll share that with the group participants by the end of the week. And you can also go onto the shiftotpp.ca website right now, and you'll find a Learn More button that actually links to that toolkit, where you'll see some details on how we found those numbers. So I don't want to take up too much time getting into the nitty-gritty details of those figures, but you can check out that toolkit, and I'm happy to chat with you offline if you have any more questions.
Yeah, and it's important to note there that the transparency is a real issue here, and so we're not able to get specific information on those types of holdings. They're not published, and so we have to sort of work back on them. And the other thing to note is that pension funds hold a lot of private investments. So these are not just shares in companies, although that's a percentage of the portfolio. Some of these are wholly owned entities, and so there is no day-to-day market price. It's actually really hard to know the exact valuation of something until you try to sell it. And so they're estimating the value in their portfolio, but it's not always possible to find an up-to-date figure of what the actual value is. So just to say that it's a tricky moving target to find out exactly, but we certainly would appreciate much better clarity from the Ontario Teachers Pension Plan on the holdings it has.
Yeah, Adam, there's another couple questions, but maybe while you have this current slide up, you want to chat a little bit about that.
This is a slide we like to put up. It just shows that a lot of people in Canada are thinking about their climate impact on a personal level, and they're trying to make changes. And a lot of people are really thinking hard about this. And some research has shown that, in fact, the fossil fuel the carbon footprint impact of an investment can be much higher than some of these sort of personal things. So obviously these are really great things to do to try to reduce your energy use, reduce the amount you fly, maybe switch away from a gasoline car to something like a bicycle or an electric vehicle. Those are all really important steps. But it's just a critical thing to understand that the money you're investing in your retirement, whether or not you're doing it personally or through a pension plan, can have a much more substantial impact. And so that's why we're saying, in addition to all of the other steps you might be trying to take to do your part around climate change, it's really important to think of investments either done personally or on your behalf, and understand where those investments are. So we find this is a very useful little slide to explain that.
Just recognizing that it's 5:01, so I know that some people have jumped off, but like I said, we're happy to stay on for another 20 minutes if there's more questions. And there's another one from James, which is, the plan and other folks in finance talk about the goals of net zero by 2050. My understanding is that leaves too much room open for continuing to invest in fossil fuels, which will put emissions well above sustainable levels by 2050. Can you talk about the science versus the rhetoric of net zero?
Right. I mean, one of the issues we've faced in the world of climate is that we're trying to express that emissions from humans essentially need to go to zero or close to zero, roughly mid-century, in order to stay within the bounds of what we've agreed to in the Paris Agreement, which is to avoid the worst, most dangerous impacts of climate change. The word net was added to allow some flexibility. And I think, well-intentioned initially. Net zero implies there may be a balance. So maybe if we're planting trees over here, that will absorb some carbon, or we need some inherent flexibility because there may be some sources of emissions we have that just may be really challenging to eliminate. Unfortunately, as has gone with everything that's gone on with climate targets, it's been abused as well. So we're seeing fossil fuel companies saying we pledge to be net zero by 2050 and not publishing any credible pathway on which they would achieve that. And I'm thinking about in Canada, Cenovus is a big one, big oil sands producer, has said we're going to be net zero by 2050. We don't know how. We have no concrete timeline or pathway to get there. And we've seen that as well from companies like Shell internationally. And so there's obviously a big sort of question mark. Just because somebody has said we're going to be net zero, that alone is not credible. What you need is a good balance of short, medium, and long-term targets. So you're going to say, we're aiming for zero, and here are the concrete measurable steps we're going to take to get you there. And that's what makes credibility happen. It works. It's important for governments. It's important for financial institutions. So if the Ontario Teachers Plan, well, one thing we really want to see them do is to say, we're going to align our investment strategy with the goals of the Paris Agreement, which would essentially put them on a net zero trajectory. But then we would expect them to put in place clear, measurable targets in the near term that would put them on a track to achieve that. And those two things are what is actually meaningful. And the same for governments. We see a lot of governments committing to net zero, but what we would like to see is politicians committing to actions that are within their own terms, within the next 4 years, within the political cycle. What can they actually do in a meaningful sense that would put us on that trajectory? I hope that helps answer some of that. But needless to say, you should be skeptical about claims about net zero on their own. They need to be backed up with credible plans.
Just a quick question from Dawn. She's just wondering, if we do organize a group for a workshop, how many people would you like to have attend?
I don't think there's a bottom number. We're happy to have a friendly call. So we're happy to meet with even a small group of people. So don't stress the numbers. More the merrier, but we'd like to chat with you and work with you if that's something you're interested in doing.
Question from Rita. She hears that from corporate nights that the Quebec Pension Plan invests 10% of its funds in green energy. The last time I got an answer from our Teachers Pension Plan folks on investments in green energy, I was told that they are investing 1% of their funds in green energy. Does anyone know what the current level of Teachers Pension Plan investments is in green energy?
Patrick, you're probably the closest person to having able to evaluate that in terms of actual numbers.
So Rita, the answer is no. I mentioned on a slide earlier in the presentation, which I think you were able to not get on for, that in 2017, the Teachers Pension Plan mentions that they had $1.6 billion invested in renewable energy. We don't really have an update on that number. It's our understanding that that's increased, but regardless, it is less than 1% than the $207 billion of assets under management currently. So it's still significantly less than that 10% that you mentioned from the Quebec Pension Plan. And we did highlight as well earlier in the presentation that the Caisse de dépôt et placement de Quebec is the public pension fund in Canada that does have the best grasp of this issue and actually has set timelines and targets and commitments to reducing its fossil fuel exposure and increasing its investments in climate solutions. So that's a good example to highlight.
Yeah, I think so. Exactly as Patrick said, the Caisse in Quebec, they certainly have a lot of carbon in their portfolio too, which we should be quite concerned about. But the thing that they've done that's different from every other pension fund in the country that puts them ahead is clear, measurable goals and targets. And so that they said they wanted to increase the amount of low carbon investment in their portfolio by a fixed amount, and they actually exceeded that. And this is the thing that pension plans can do. They can move markets. They can, and we're talking about international investments here. We're not talking about within Canada. So there are lots of good investments to be made in that sector at a global scale. We just saw the Canada Pension Plan this year bought Pattern Energy, North America's one of its largest wind energy developers. And the company is now worth $6.6 billion. So the scale is there, and these are highly profitable investments. So what we're hoping that the pension plans do, and what we hope that teachers will do, is really invest in the expertise and staff internally to be able to go out and find those projects. We know that the pension plans in Canada have a lot of expertise in they have whole teams dedicated to energy, and they know how to find fossil fuel projects to invest in. And we haven't seen that level of effort and capacity put into finding clean energy investment. And so that's one of those cultural changes that needs to happen.
We have 2 more questions, so I think we can keep rolling here. Chris is asking, can you comment on investments opportunities in adaptation as well as in mitigation? Are institutional investors looking yet at adaptation as profitable, and are there opportunities there?
Yeah, absolutely. It raises interesting questions about private ownership of public goods sometimes. So, you do have to worry about certain things like pieces of infrastructure being owned by private entities. So there's that debate raging. But aside from that, I think, if you're looking at teachers specifically, they already own huge amounts of infrastructure and real estate and real assets in the world. And so their adaptation investments will fall fully within the bounds of their own existing companies and so if you're thinking about for their buildings, they can be making adaptation investments in them right now, and those are likely to pay off in terms of resilience to those physical impacts I talked about. So we're talking about stormwater management. We're talking about passive heating and cooling. We're talking about resilience to extreme events, those sorts of things, and that's the adaptation side that can be invested in. So there's quite a bit there to do. There's a really renewed focus that's quite interesting internationally in natural climate solutions. So investing in biodiversity and in trying to enhance natural solutions to climate change, which have a number of other associated benefits, including energy use reduction. So that's another area where I think we're actually seeing asset owners like teachers are actually part of those conversations.
Thanks, Adam. Just one more question that I have here, but before we get so, just remind folks that I've pasted our Facebook, LinkedIn, and Twitter sites into the chat. So if you want to get more information on the financial risks of climate change, on the teacher's pension plan, on SHIFT's work, I'd encourage you to follow us on those social media sites. And I'd also just ask Adam to put up our engagement slide, a few slides before this one, just as a reminder of some of the different services we offer, whether it's webinars or our toolkits or action tool, in case folks are interested in doing more. There we go. Yeah.
That's the one. No.
The one after that. One before that, sorry.
Yeah. Sorry.
And yeah, and you can go, like I said, to shiftotpp.ca right now and send that letter to the pension plan as a first step. And last question from James: how do you respond to those who claim natural gas is a viable transition fuel and shouldn't really count as a fossil fuel?
Yeah, really good question. So yeah, natural gas is a fossil fuel. It's a major contributor globally to carbon emissions and has been since it was developed. It's, you know, even the term natural gas is a little bit of a marketing term. We call it fossil gas sometimes. And certainly it is a much cleaner burning fuel, both in terms of air pollution and GHG emissions compared to coal, but that's about the only place where you'll find it's cleaner. GHG emissions are very substantial. And I've actually been involved in working on some analysis that shows on a global scale that already natural gas investment exceeds what's possible if we're going to actually transition. So if we make new investments in gas infrastructure, be that connections to buildings, you know, natural gas pipes, distribution and transportation, LNG, which is liquefied natural gas, which is importing and exporting natural gas internationally, those investments will be stranded if we actually intend to meet the goals of the Paris Agreement. And so that's that long-term view I was thinking about. So, and that is completely in addition to what we're also discovering, which is that methane, which is another one of the powerful greenhouse gases, is a substantial pollutant from the gas industry. So the extraction of gas, transportation of it, and obviously natural gas itself is largely made of methane. The methane emissions from the industry are additional and extremely substantial, and there's a lot of leakage there. So the industry is not part of a future that deals with climate change, unfortunately. So it's really critical to understand that we don't want to be dead-ending ourselves in our investments. It makes no sense to invest in something that will then further entrench us into fossil fuels for additional decades. We need to be making investments that put us on track to getting to that zero that we need to be getting to. And it's a very difficult thing to do. And we shouldn't be tying our hands behind our back by continuing to lock ourselves into those kinds of infrastructure.
One last question came up, and that's climate change unfolds in a slow motion, so people don't think it's real. How do we get more teachers and the Ontario Teachers Pension Plan to acknowledge that this is a real crisis that needs urgent action?
Yeah, that's a really good question. I think the slow motion part has been occurring for some time now. The whole career I've had working on climate change has been unfolding slowly in slow motion. I think we're almost at the end of the slow part. If you look at recent years, the way the impacts have been cascading and accelerating, we're really at a moment now where we're starting to see a very scary increase in climate impacts. And that's been a big issue for a big part of the reason I think why many Canadians have gotten to understand climate and have really cared about this issue in the last couple of years, because we're seeing annual forest fires getting worse and worse. We're seeing flooding and droughts. We're seeing food prices going up and those sorts of things. So that's scary, and I think it is driving motivation. But I think the moral authority is, and I think teachers are really exposed to this in a very unique way, is young people. Understanding as soon as they're taught and understand the science behind climate change, their immediate question is, really? What are you doing about this? You've known about this for how long now? And what's the action? Tell me right now what's going on. And the first people they have that conversation with tend to be their teachers. And so we're seeing the Fridays for Futures movement has had a really tremendous impact on a global scale. And I know a lot of teachers who've been thinking and worried about climate change for some time have been motivated to sort of step out and stick their neck out a bit further. My mother's a retired Toronto elementary school teacher, and so she's been exactly that category. She really cares about climate, but she hasn't tipped over into that point of sticking her neck out to be active on it. And she's definitely she's moved there in the last short while. So I think that's something that may be why so many teachers have decided to join this particular webinar. I hope. Anyway, I just think that's where most of the moral leadership is coming from at the moment.
Yeah, we actually have another question coming in. I'm noticing that we still have a significant chunk of our participants staying on after 5 o'clock. So I just want to underscore that we really appreciate that it's a beautiful day outside. And we really are glad that you guys have stayed on for this workshop and attended. So another question from Chris. Can you comment on the Ontario Teacher Pension Plan's investments in secondary fossil fuel industries, namely auto and aircraft makers, petrochemicals, etc. In your view, should those also be pressure points for climate activists?
Yes and no. Certainly those fall squarely into the category of at very high risk from technological disruption related to climate change. And that disruption is well underway in certainly in auto manufacturing and a number of different other areas. And I don't think the same approach applies where you want to pull your investment fully. But that's one of those areas where I think actually engagement could have a real impact. I don't personally believe that engagement with a fossil fuel company is likely to yield anything meaningful in terms of long-term reductions. I don't see a path for engagement to be super effective in that context. But engagement with an auto manufacturer that has been dragging its heels, as a good example, it's been dragging its heels on making investments in electrification, could really be pushed to do so by its owners. And I think there's a really strong financial argument there. You know, we're seeing a number of major auto manufacturers pretending that electric vehicles are not ready for prime time and are not coming, and they're actually already losing market share and facing very significant financial impacts from their decision to ignore this coming at them. In Ontario, we see the GM plant in Oshawa. It's everybody's been laid off, and the company, nobody in Canada is talking about how we can bring electric vehicle manufacturing into the country. Those kinds of investments are the only way I think Ontario is likely to grow its auto manufacturing base in the future. If we're not going to be manufacturing electric vehicles, that may not happen. And so anyway, that's just one area, but there are a number of other areas that I think that's where you should be asking your pension fund to be engaging actively on that, to push the companies that they own to be actually accelerating the transition internally.
Yeah, just to add to that answer, Chris, in a lot of my research on the pension plan, it's shown that they own a series of airports actually in the UK and throughout Europe. And in their responsible investment reports, they actually use it as an example of environmental progress because those airports have net zero targets. They have electrified their fleets or use renewable energy for their airports operations, and that's a good thing. But it does raise the question of whether the entire aviation industry is sustainable or aligns with a climate safe world. And we've actually seen since COVID hit that those airport ownership and investments have taken a hit, obviously, because they were solid investments that provided good returns before, but now because of COVID, they're not looking so good. There's another couple of areas that relate to climate change that aren't necessarily directly related to fossil fuels. So the Teachers Pension Plan owns a desalinization plant in Sydney. Obviously that Australia is going to be experiencing some water stress in the future. And it means that they are going to be able to provide safe water to a community as that water stress really starts to take hold in Australia. And then they also own Chile's privatized water utilities. So there's a whole series of ethical and financial questions here that's, like Adam said, the pension plan should be engaging on, and you should be asking these difficult questions of why they hold these companies and how they're trying to improve their performance.
I think just to underline one final point, which is really critical, and I should have mentioned it earlier, which is fossil fuels. It seems like we're really focused on fossil fuels and we're obsessed with them in our conversation around climate, and obviously they're critical. But if we expect major institutional investors like teachers will eventually screen and divest from fossil fuels, whether or not they explicitly put a policy in place or not. I think that's an inevitable long-term conclusion given what we know about climate change. But we'd like them to do it soon, if possible, to move their money out of those investments. But that alone isn't enough to do what we're hoping they'll do. It's much more important that they're shifting investments into the low carbon opportunities. The investment is probably more significant in many ways than the divestment side of this conversation. And as you mentioned, all of those other sectors which aren't fossil fuels but are related to the transition are part of that. And so there's a lot of understanding about this disruption that they need to have. So we're really happy to see that Teachers is actually working behind the scenes on understanding their risks in a number of different sectors. But what we need to be asking them is, what are your clear and concrete measurable plans to address those risks? And they should be able to, they're in early days of figuring those questions out, but they should soon be able to provide a clear answer, or else we should be worried about it.
We have 2 more questions, Adam, then I think we'll probably cut it off there because we're getting toward 5:30.
Right, these are great questions, but we should wrap it up soon.
Yep. Zane's asking, I'll read them both at once. Zane asks, what are your thoughts about the divestments as an effective strategy versus engagements? And Toshiko asks, would you consider a desalinization plant to be a type of adaptation investments in regards to Chris's comments?
Yeah, so engagement versus divestment, that's a critical question here. And what we've not seen, most of Canada's pension plans say, we believe in engagement, not in divestment, because as asset owners, we feel we have more control over the behavior of the companies if we own them. But that's not backed up by their track record on engagement. So we're not seeing a clear strategy. So when you ask Ontario Teachers Pension Plan, what is your goal for engagement? If you plan to have an impact with your engagement, what impact are you hoping to have? Do you want to see companies you own reduce their carbon intensity by a certain percentage? Do you want to see what thing in the world where's the policy? Where's the internal policy that says these are our measurable, achievable goals? And that's missing. And the track record on voting is also missing. And frankly, the credibility of engagement to eliminate carbon when you own a fossil fuel company whose sole purpose and expertise is entirely based on extracting and exploiting fossil fuels. I don't think there's a credible story there that company can meet the goals of the Paris Agreement. And so there are real questions there. So I think engagements is certainly a very important tool in the toolkit. If they are planning on using it and they want to rely on that to deal with this issue, they better have a lot stronger approach than what we're seeing. But in many cases, we think it's a combination of both that and screening and divestment will be required to eliminate the risk from your portfolio. On the desalinization, yeah, it's an open question. It depends on the circumstance there, but yes, potentially a desalinization investment could be a good climate adaptation. I think there are a lot of questions about water stress around the world. There are some ethical issues with desalinization in that it's very energy intensive. So where the energy comes from to desalinize water could actually be quite carbon intensive depending on the investment. So I just want to frame that unto itself has raises other questions that we should be asking. And on that note, I really want to thank you all again for coming out. And I hope you've learned something. If you have further questions or you want to engage with us in a more detailed conversation, we'd really love that. You can get us info@shiftaction.ca anytime, and we'll respond, Patrick, or I will respond to you directly. And we really hope you have a lovely Wednesday evening. And thanks again.
Thanks so much. And thanks to Kim and Terry again for joining as participants.
And yeah, good night.